Hello, everybody. Welcome to Outside Factors, where Noah and I talk about what's happening outside the real estate market. But I would like to always start with the real estate market. Right now, we are seeing a bit of a slowdown happening in both Manhattan.
Yeah, thank you, John. Welcome. I mean, there's a lot of outside factors. I love the title. Thank you very much for doing that. That are impacting our markets. And look, from where I'm sitting, right, and looking at this whole thing, it's June 1st, right? So you know what starts today? All right, the Fed is going to start tightening their balance sheet. They're going to actually start selling off assets to their balance sheet. Now, I know this is probably not what you did not expect to hear on a Manhattan real estate type of discussion, but you got to follow the Fed. You got to follow the liquidity. You got to follow the liquidity flows, because that ultimately affects the equity markets. It potentially affects the credit markets. And at the end of the day, the equity markets and the credit markets will have a second derivative effect on New York City real estate and investment and et cetera. So even though there's not a direct correlation, there is a connect the dots ending correlation to what I'm doing, what I'm talking about here. And take a look at this. This is what the Fed, our Federal Reserve, has done with the balance sheet. It's at 9 trillion. 9 trillion. And this is now starting today. They're selling, I believe, like 17.5 billion in mortgage-backed securities and another 30 billion in treasuries. And they're going to be doing this, and this is going to happen. And this line, okay, is going to start going down, right? So now you're going to start to see equity market volatility. You're going to start to see the rates doing their thing. You have a tightening Fed into a rising interest rate inflationary bear market. Okay, that's a lot of words, but if you just listen to what we're saying, you got a tightening Fed in a rising interest rate inflationary bear market, which is something that we haven't seen in a long time. Manhattan real estate, it has a couple of good things and it has a couple of bad things going for it, right? The good things is the fact that it did not do parabolic rises, John.
Right.
It's not up 50% in the last couple of years. So in that sense, it's not going to have that violent rug pull where the bid just disappears and there's a big gap down in price and it could drop 15, 20% overnight kind of a thing. Markets that have parabolic rises are going to see that type of, normalization in the market. Manhattan didn't have that. Brooklyn didn't have that. So that's one element. Secondly, we're not at full capacity. Right, we've talked about that. So we have some. That's the bad part of it. That's the bad part of it. So that's why we did not do the parabolic rise. But the fact that we're not at full capacity is actually going to protect us down the road, because we're going to be going. As time goes on, you're going to have a market that's actually getting closer and closer and closer to full capacity, and that's going to act as a floor to how down this market goes.
Yeah, I would agree with you. And I think the point I'm taking away is that relative idea, right? The markets, the stock market, the credit markets, those have been up fantastically. They've come down pretty fantastically too. So there's a lot of volatility there. That's going to translate, as we are now. We're sort of in this period where the bid and the ask aren't lining up. We're seeing the same thing in the real estate market, and that itself breeds volatility. What does that mean? You're going to have some big up days. You're going to have some big down days. It's going to feel like there's a lot of uncertainty out there. So even in the Manhattan and Brooklyn real estate markets, if we're not seeing those massive moves in prices, we are going to see it at the bid ask level between buyers and sellers. Sellers are going to be one place, buyers are going to be another. And that means the negotiability is going to be fluctuating. And instead of being down below 3%, it might increase up to 5-6% as we enter the summer here.
Yeah, and I think that's very possible. And if I'm a buyer, I'm focusing on late summer, early fall, as maybe things will play out by then. It's going to give me some peak leverage. You don't have it now, Johnny. And let's be complete. The bid ask, it's all about the bids, right? So the bid ask, looking at the spread, that's exactly what you need to look at. But take a look at this, John. This is 1 month contract signed. We're still doing 1,300 deals, Johnny. We did 150 during the shutdown on a monthly basis. That's how low this got. Quite simply, if you're a buyer, you're not going to get a lot of negotiability and swings, price action in your way until this drops. And that's the point. Like, you're not seeing the bid drop. You're seeing it fade. Now, if this starts to get on a 30-day level below 850 and 800, okay, that's going to be a relative shock for a market that has seen insane transactional volume over the last 17, 18 months. We've been over 1,000 for 90% of that time. So this will be a deal volume shock if it happens. It has not happened. And if I'm a buyer, I'm focusing on this to see when my peak leverage is going to be and how far the direction may go. So far, it's happening at a very slow pace. Maybe the rental market has something to do with that.
Yeah, it's quite possible, and that's doing gangbusters right now as well. Simply because there's just not a lot of supply out there at prices that people would consider overly affordable, right? The rents have essentially gone up. But to put this all back, we're talking about outside factors. The idea is that we're entering a period of volatility in the stock market, in the credit market, that's most likely going to affect Manhattan real estate simply because that lack of certainty that volatility generates, right? You're heading into an uncertain period that usually translates into a wider bid-ask spread, which translates into more negotiation.
Yes, and lower deal volume. And at the end of the day, if I'm a seller, think about what you're going into right now, right? We're going into August is our lowest deal volume month, right? So you're going into June, July, and August, which is declining deal volume. You got a negative wealth effect with the stock market. You got rising interest rates. Again, lucky for you, you're in a market that has relative value and it has a floor, right? We saw what it did during the pandemic. So I don't see that happening here at this point. But if I'm a seller, I'm making my decisions now and I'm making them quick.
All right. Thank you, Noah Rosenblatt. I am John Walkup. Thank you for watching Outside Factors, and we will see you next week.